Hi, and welcome to another Strategic Equity Management Economic Update. My name is Jeff Hybiak, and I'm the Portfolio Manager for Strategic Equity Management. Today, I want to give an update on the current state of the economy, as well as where we might be going into the next year and what that might mean for our investment portfolios. Now, back in the mid-2000s, several economists coined the term muddle through, basically describing what they thought the next 10 years would be like. And it's essentially what it sounds like. We're going to kind of get through it. And if you look at where we're at today, they were really pretty close to accurate. And what we're looking at as we move forward is the potential that we are still in a muddle-through economy, and that may not bode so well if you're a stock market investor. Now, this chart of GDP really shows what a muddle-through economy is. We've had positive economic growth, but it's failed to hit the long-term average growth rate at any one point throughout this recovery. And what's really concerning is that's despite unprecedented stimulus measures via the Federal Reserve, Congress, and other things like that. And with the Fed's recent announcement that they were going to be cutting interest rates, now we start to run into the question of, if we were only able to get subpar growth with all those stimulus measures, what does the future hold? Overall, our leading economic indicators continue to point to a muddle-through type economy. We're talking 2.1 to maybe 2.5 tops if everything falls into place correctly, which is about in line of what we closed the year at. So it's not looking to be a great 2016. What really concerns us is that growth rate when we started 2015 was pushing 3%, and we've not seen much improvement in many of those indicators. In fact, we've seen deterioration in some and not enough of an improvement in others to really get excited about. And with the Fed raising interest rates, that could be something that we need to pay attention to. The most recent report on housing was a good one. It just blew away expectations. However, there's a lot of seasonal factors in there. There's some swings in multifamily housing and things like that. And to try to weed through all of that, we tend to look at year-over-year percent growth. That way you get rid of seasonal factors and you're just looking, how well are we doing versus a year ago? Now, our longtime followers know that housing starts and building permits are by far one of my favorite leading economic indicators. Why it works, why I like it so much, it's kind of a chicken and egg type thing. We can think logically why building a new home would cause some tremendous growth in the economy, but we could also conversely think why a strong economy could cause strong growth in housing. Which one it is, I don't know, but as this chart shows, it's been a pretty dang good indicator of which direction the economy is going. As you can see, housing starts, which come out monthly, versus GDP, which comes out only once a quarter, it tends to pull GDP higher. And what we see, even though we had better than expected numbers, if you compare those to where we were at a year ago, we're right back in that muddle-through economy. Now, if housing does turn around and keep up the momentum that it had in November, definitely that could be a good thing for the economy. Now, I am debated including employment also in that good category because it has been good. It has been decent, but this chart shows why I didn't, and that's really the bad of the economy. Employment growth just hasn't had much correlation with the underlying economy lately, and that kind of leads us into what that might mean for the economy. And so there's something clearly going on with consumer spending. It's tracking, as you can see, I have the trend line growth in there. It's tracking below what most consider normal. We would expect to see accelerating growth rate. We've also seen some economic models that predicted we'd see a big jump in consumer spending just not come through. We've had almost a year of constantly falling gasoline prices, and that hasn't equated into additional spending. What we're seeing is consumers are choosing to pay down their debt, or they're getting, not wanting to spend the money because they perceive higher healthcare costs or education costs or whatever that is. But lower oil prices have not meant extra spending. Higher employment has not meant extra spending, and I think that's something that economists are really struggling to get a hold of as to why that happens. And if you listen to the Fed's announcement and their press conference, they believe that it's just a transitory thing and the consumer spending is going to pick up in the next year. I'm more of a let's wait and see type of economist when I look at that, and right now the data says that we're just not seeing it. Now the ugly. Even though manufacturing represents less than 30% of our overall economic output, consumer spending is by far the vast majority, and we have government spending, which is a small component as well. Manufacturing continues to be a very highly reliable economic indicator, and it just makes sense. If people are excited about the economy and it's growing, particularly manufacturers' new orders are going to be picking up their growth rate. And I like this ISM survey of manufacturing data because it's very straightforward. If it's above 50, it indicates data that is typical of an economic expansion. If it's below 50, it indicates data that's typical of a recession. And as you can see, it once again dipped down to that level below 50. Now, we did have a false alarm back in 2012, but I would caution everybody to remember that that number was then greeted with QE3, which then, as we all know with hindsight, just launched a tremendous rally in the stock market. It did equate to some stronger than we had been seeing economic growth. Still didn't hit above average, but we did get some stronger growth. Now we have manufacturing indicating a recession. At the same time, the Federal Reserve just announced they're raising interest rates. So really, what is the Fed thinking? In a normal environment, I don't think there is any way the Fed would be raising interest rates right now. Economic growth is simply not overheating, and inflation is nowhere near being a problem. The issue the Fed is really facing is trying to figure out how to get out of all those unprecedented measures that they've been using to get back to more of a normal policy stance. We've had 7 years of emergency measures to fight the financial collapse. And Janet Yellen's Fed has been very slow to move. They've been given the markets almost a year to get used to not having quantitative easing anymore. It ended at the end of 2014, and they've kind of let things go in 2015. Although they were teasing us all year about possibly raising interest rates, they've been slow to move. What we really have to keep in mind here is this table shows this is only the 4th time since 1992, which is when our company began, when most other advisors out there were in business. A lot of them have started after strategic equity went into business. It's only the 4th time that we've seen the Fed going through a rate tightening cycle. And what that means is we're not quite sure what the impact will be. Now, minus 1994, if you look back all throughout history, there's very few cases where the Fed has started to raise interest rates where they haven't caused a significant contraction. You could see the last 2 times with Alan Greenspan sitting in the chair. He basically ground the economy to a halt, and then shortly thereafter had to start cutting rates because we were in a recession. You could see that the gray bars there on that chart show the recession. So we got to be careful of just believing that, hey, the Fed's raising interest rates, that means everything's great. If you look at that, the economic growth we're seeing right now is significantly slower than the last 2 times the Fed started raising interest rates. And the last 2 times they actually slowed things down. So I don't know what the Fed is seeing out there. It becomes critical to really ignore all you're hearing out there. Ignore the short-term reaction in the markets, and especially don't let the short-term reaction of the market dictate your assessment of the data. That's what we're here for at Strategic Equity Management. Sorry, the slide wasn't moving. Our whole philosophy with everything, whether it's our economic models, whether it's our method of management, whatever it is, our policy is to look at the data, compare it to history, and determine where we're at. Right now we're seeing the economy 2.2, maybe 2.5% tops. Long-term average is 3.2%. Markets typically, over the long run, track the direction of economic growth. If economic growth is going to be below normal, therefore we should expect long-term growth of the market to be below normal. However, if you look at Wall Street strategists for 2016, they're overwhelmingly bullish. I couldn't find a single one that was even expecting some sort of a correction in 2016. We have several that are predicting average, and then we have a handful predicting above average growth for the market. Economic data just doesn't play out that way, and it's something that you have to be very careful of as you move into the new year and you set your investment portfolio. Now more than ever, it is a great time to use the resources available at stratequity.com. We have all kinds of different things for you. If you don't want to register for our site, just go to our website, stratequity.com, and we will weekly post our podcast. It gives you a summary of what's been happening in the market. It just takes a look at things that are important at that time, and we'll, as necessary, give our outlook and our allocations in the market for our portfolios, at least for that week. Also, we will post these economic updates. If you want to check back, I try to get to them once a quarter. Especially this year, I think it's going to be very important to watch the direction of the economy. If you want a more detailed analysis of the market, I actually post a trader's blog, but because of regulations, we do have to control our audience a little bit on there. You can register for our website. That'll be the only time we contact you. Whether you're an investor or professional, click on that link there, and that will be the only piece of information you get from us. If you want to contact us additionally, you will be the one in charge of that. You'll get that confirmation email, confirm you're not a robot, and then check in every day, every week, however often that might be, and see what our take is, not only on the markets, but the economy, as well as how our portfolios are adapting. So I hope this update finds you well. It has definitely been an interesting 2015. We're hoping that things might settle out. Hey, if the market rallies, great. We will be on board. We will love it. But if it doesn't, that's where you really need active management. And if you don't have an active manager, if you don't have a strategy for the what if the market goes down, I'd urge you to take a look at your portfolio. Consider strategic equity as a possible option for a portion of your portfolio. So as always, we thank you for joining us, and we look forward to the next update.